In this lesson, we're going to talk about gaps in the market. Gaps are interesting. They typically happen after hours. So when the market is closed, right? Typically there might be, when the market reopens, there might be a gap in price. And I'll show you exactly what I mean here on the chart. So gaps are typically caused by news after hours, meaning that the market is closed. There's a news announcement that happens after the market is closed, and then when the market opens, there's a massive gap, right? So in the stock market closes every single day, right? So it's, when you're looking at the New York session, the stock market will close at the end of the New York session and reopen at the start of the New York session. A lot of the news announcements in regards to the company itself. Let's talk about Apple, right? If Apple has earnings will typically happen right after the session closes, right? So they will drop their earnings after hours, after the market closes. And then when the market reopens, there's going to be a big gap, right? Because people are already reacting to price and so on. So when the market reopens, there's a gap in price. In Forex, as an example, in Forex, the gaps will typically happen over weekend, right? So because Forex market is open 24/5, right? 24 hours a day, 5 days a week, right? It closes over the weekend. So there's something that occurs over the weekend, a big news announcement over the weekend, or some kind of economic event or global event over the weekend. Then when the market reopens on Monday, it could cause a big gap in the market as well. For crypto's open 24/7, right? So cryptocurrency does not have that many gaps unless there's just massive volatility in price, and then there's no liquidity and price just continues to gap and gap and gap. But that's kind of what gaps are. Let me jump on the charts to exactly show you what I mean by that. So again, just remember the concept. Gaps mainly and pretty much only occur, I don't want to say only, but majority of the time they occur after the market is closed. And then when the news announcement happens after the market is closed and the market reopens, there's a gap in price. So what we have here on the chart is the Apple stock price, right? Stock charts. So check it out on the monthly chart here. There was a massive gap in price right here, right? October 2019. Actually, this is a 4-hour chart, right? So right here, there was a big gap in price. Boom, market opened up, it gapped, So look at the 1-hour chart. Pretty much every single day, there's a slight little gap at the start of every single day. There's a slight little gap in price. If you look at the higher time frames, right, daily chart and so on, you can see that almost every day, but there are periods in time when there are bigger gaps, right? So the stock market is very gappy like this. You can still read the price action. You read the price action as normal, right? Just because there's a gap on a time frame, it doesn't really mean much. There's still price action within there. There's still a reason why price action went up and caused that gap, right? So when you're looking at price action patterns in general, you can ignore the gaps because in reality, there's a reason why the gap happened. Behind it, there is price action, like a news announcement, whatnot. It just happened when the market is closed. If the market was not closed, guess what? There will be no gap. There would be a candle there, but the market was closed, so there's a gap. No big deal there. Literally there is no big deal. Just read it as normal, read price action as normal. But that's what I meant by gaps. Gaps can make price action look a little bit weird, specifically when trading the stock market. In the currency market, they don't happen that often. Once in a while over the weekend, something might happen. So there might be a gap in the currency market, but in the stock market, it happens daily, right? So that's why I want to focus on the stock market here. And you can clearly see within the Apple share price that, again, is just very gappy. But in general, just read the price action and the candlestick formation the same way. Gaps, no gaps, it's the same thing. Because we have a gap, just imagine if there was no market close, if the market was not closed, there would be no gap there. There would be a candle, right? So that's kind of it. So that's it for this lesson on gaps. Gaps are pretty simple. I just want to really explain it and show you exactly what I mean by that, just so that when you're watching the charts and you notice a gap happens, you're not sure what it is. That's the reason why it happens. It means that the market was closed, something happened in the market, whether it's related to the company or the economy or whatnot, once after the market was closed, something happened, and then when the market reopened, there was a gap in price. But if the market was open and that news announcement happened, I mean, there would be no gap. It would just be a candle there. That's the only difference. The difference is that the market was closed, period, right? So that's it for gaps in this lesson. Hope you enjoyed it, and I'll see you in the next one.